How inflation is eating into your savings if you are not investing. Inflation is often described as the silent thief of wealth, gradually eroding the purchasing power of money over time. Simply put, inflation means that the same amount of money today will buy less in the future. Inflation is slowly diminishing your money's value without you realizing it. Here's how it happens. Understanding inflation's impact. Inflation is the rise in the general price level of goods and services. A typical inflation target set by central banks is around 2%. While this might seem small, its long-term effects are substantial. For example, if inflation is at 2% annually, something that costs $100 today will cost $102 in 1 year. Over a decade, that item will cost $121, meaning your $100 today will only be worth $83 in purchasing power after 10 years. Savings in an inflationary environment. If you keep your money in a savings account, under your mattress, or in cash, it's not only missing growth potential, but actively losing value. Most savings accounts offer interest rates that don't keep up with inflation. For instance, if inflation is 3% and your savings account earns 1%, you're losing 2% of your money's value each year. Your balance might stay the same, but its real value is shrinking. A $1,000 saved today could only buy what $970 would buy next year with 3% inflation. For those relying on fixed income sources like bonds or traditional savings accounts, the impact of inflation is more severe. While these assets provide steady returns, they often fail to outpace inflation. This is problematic for retirees or anyone living on passive income. Without investment growth exceeding inflation, the purchasing power of fixed incomes erodes. Investing is one of the best ways to protect against inflation. By placing your money in assets like stocks, real estate, or other growth-oriented investments, you can potentially earn returns that exceed inflation. Historically, the stock market has delivered average annual returns of about 7 to 10 after inflation, far surpassing typical inflation rates. Certain assets perform well in inflationary environments. Real estate, for example, tends to appreciate in value as prices rise, offering a hedge against inflation. Stocks, particularly those of companies with strong pricing power, can also help protect against inflation since they can pass on higher costs to consumers, maintaining profitability. Investing is not a quick fix. It requires a long-term approach. Over time, compounding returns and inflation protection can significantly boost your wealth. While investing can protect against inflation, it's essential to diversify your portfolio. A mix of asset classes, stocks, bonds, real estate, and commodities spreads risk and increases the likelihood of higher returns. Inflation is a constant threat to your savings, quietly reducing your money's purchasing power over time. If you're not investing, you're letting inflation win.